Meta is cutting 8,000 jobs. Microsoft is offering buyouts to 7% of its U.S. workforce, roughly 8,700 employees. Together, that is more than 23,000 positions trimmed in a single week. Yet both companies are simultaneously pledging to spend more on artificial intelligence than at any point in their history. Meta is pouring billions into AI infrastructure. Microsoft has committed to $110 to $120 billion in capital expenditures for fiscal 2026 alone, a 66% jump from the prior year. The same executives announcing layoffs are also announcing record spending. That contradiction is not an accident. It is the business model. Microsoft's Azure cloud growth grew 39% year over year in its most recent quarter. Commercial backlog reached $625 billion, up 110%. The AI investment is working, but it is also restructuring what kind of work humans do inside these companies. The voluntary buyout targets senior directors and below, whose age plus years of service totals 70 or more. That is not a cost panic. That is a deliberate reshaping of the organizational pyramid to match an AI-first operating model. Microsoft stock fell 4% on the announcement, its worst session since February, pushing it down roughly 14% year-to-date. The market reaction reveals the real investor anxiety. Not that the AI bet is wrong, but that the spending may outrun measurable returns before margins can absorb the pressure. 55 analysts maintain buy or strong buy ratings on Microsoft, with a consensus target near $580 versus Thursday's close around $415. The bull thesis rests on Azure compound growth and an emerging AI productivity flywheel inside the company itself. The risk is timing. If AI-driven efficiency gains take 2 or 3 years to flow through to operating margins, the buyout program today looks like a leading indicator of margin pressure tomorrow. The same afternoon Microsoft's buyout landed, ServiceNow reported first quarter earnings, and the enterprise software sector cracked open. ServiceNow fell 18% in a single session. Salesforce dropped 9% on no company-specific news at all. The contagion spread across the category, pulling cloud software names to multi-month lows and putting the Nasdaq Software Index on track for its worst week since early 2025. The mechanism behind ServiceNow's plunge was specific. On-premise deals in the Middle East slipped. Clients tied to the Iran conflict delayed contract signings. That created a 75 basis point drag on subscription revenue that analysts had not priced in. Simultaneously, margin guidance came down because of acquisition costs from the company's $7.75 billion Armis deal. Goldman Sachs, Jefferies, Piper Sandler, BTIG, Canaccord, and KeyBank all cut price targets within hours. Most kept buy ratings, but the targets fell from ranges near $175 to $200 to ranges near $85 to $165. ServiceNow is now down 45% year-to-date. The deeper issue driving the sell-off is a repricing of AI disruption risk across enterprise software. Investors spent 2024 and early 2025 paying premium multiples under the assumption that AI workflow automation would accelerate enterprise software adoption. ServiceNow's miss forces a harder question. If even the platforms supposedly delivering AI productivity gains are seeing deal slippage and margin compression, how durable is the category's growth premium? ServiceNow's May 4th Analyst Day is the next critical event, where management will need to answer questions on AI monetization, Armis integration, and the Middle East pipeline. Until then, the sector is repricing on uncertainty, not evidence of structural collapse. While software sold off, two opposite forces were building underneath the market's surface. The Iran war and its grip on the Strait of Hormuz pushed oil above $100 a barrel and U.S. retail inflation to a 2-year high. United Airlines cut its full-year earnings forecast from $11 to $7 per share and warned that summer fares may rise 15 to 20%. Lufthansa cut 20,000 flights. The energy shock is not contained. It is bleeding into every cost structuring that depends on fuel, freight, or chemical inputs. But late Thursday, after the market close, Intel reported first-quarter earnings that erased the day's anxiety for the semiconductor sector entirely. Intel posted 29 cents per share on $13.6 billion in revenue, against a Wall Street consensus of 1 cent EPS and $12.4 billion in revenue. The company guided second-quarter revenue to $13.8 to $14.8 billion, well above the $13.1 billion analysts expected. Shares surged 15% in after-hours trading. AMD climbed 4% on the read-through. ARM holdings also jumped. CEO Lip Bu Tan credited the transition from foundational AI model training toward inference and agentic workloads, a shift that is driving sustained demand for Intel CPUs and advanced packaging capabilities. The weight of evidence Thursday pointed toward a market that is bifurcating. AI infrastructure hardware is winning, even as AI application software faces a valuation reset. The logic is that chips and compute power are the picks and shovels of any AI build-out. Demand is more visible, more contracted, and less exposed to deal slippage than enterprise software subscriptions. That thesis holds as long as AI capital expenditure cycles continue. If Meta or Microsoft signal a pause in infrastructure spending, which their workforce reductions have so far not suggested, the hardware rally loses its primary narrative support. The benchmark to watch before the weekend: Microsoft reports quarterly earnings on April 29th, and Alphabet follows. If Azure and Google Cloud guidance both hold above 35% growth, the AI infrastructure trade survives the software sector's bruising week intact. If either misses, Thursday's software sell-off will look like the beginning of a broader repricing, not a one-day anomaly.